Hello everyone, I'm your host Kunal Sodhani from Global Trading Center, Shinhan Bank India, and we are here to unveil the domestic factors, decode the global sentiments, and understand and analyze several currency pairs for the quarter July to September. So let's first talk about the domestic factors, starting with flows. So if we talk about the equity flows for the month of June, it has been to the tune of 14,000 crores, while if we talk about debt, it has been to the tune of around 11,000 crores. But if we talk about the total 2024, the equity flows have been flattish or slightly negative to the tune of 9,000 crores, while the debt flows have been positive to the tune of 65,000 crores. In fact, the best part about debt flows is for the year 2024, April is the only month where we have seen outflows. Rest, there have been inflows in the debt segment. Also, one important parameter here is because of our inclusion into the JP Morgan GBI EM Global Index, where this is starting on June 28th, and the expectations remains that we will have a weight of 10% over a 10-month period, and we can attract inflows to the tune of $25 billion. Also, this announcement was made in September 2023, and since then till date, even when it is not started, we have seen an inflows of around $10 billion. Secondly, apart from this, we also have an inclusion into the Bloomberg index, that is for FAR bonds, that is fully accessible route, to the tune of again 10%, but it will start in January 2025, where again we can see inflows to the tune of $3 billion. So healthy inflows for India. Second, but if we talk about FDI flows, we have something to worry about, because FDI flows have dropped to the tune of $9.8 billion for FY 23-24. Earlier it was around $28 billion, and before that it was to the tune of $49 billion. So effectively in the last 3 years we have seen a drop in the FDI flows. In fact, our ranking has also dropped 7 points, and we are standing at around, in the global FDI, we are standing at 15th position. So this remains a concern, and why? Because of the repatriation of capital remains one of the major reasons for FDI flows to be lower. If we talk about the FPI and the FDI flows are more permanent in nature, while FPI flows are more like hot money. So concern definitely remains on the FDI front. Also, if we break down into Q4 FY24 FDI inflow, then it is to the tune of $2 billion, while Q4 FY23 it was to the tune of $6.4 billion. So even quarter on quarter comparison sees a downfall on FDI inflows. Now let's move on to the other parameters. Let's understand the trade deficit number for India. For India, the trade deficit number came in at around $23.78 billion, which is lower since October 2023, where the number was around $31 billion. So this deficit definitely have a breakup of imports and exports, where imports were obviously higher to the tune of around 7%. While if we talk about imports on a longer tenor, on a year-on-year basis, it was around 7 to 8%, but on a month-on-month basis, it was around 14% higher. So major reason definitely remains import going higher. Exports were also higher to the tune of around 8%, and even year-on-year around 8 to 9%. So export was still healthy, but higher imports, and these imports were mainly into the petroleum products. In fact, also on the transport equipment products, which were not expected that much. Electronic goods, vegetable oil and pulses were the major contributors for the trade deficit to be higher. But on the other hand, if we talk about the current account, that has been a surplus which was expecting, and we came at a surplus of around $5.7 billion for the quarter end, we can say, of March. Vis-a-vis the last quarter, we had a deficit of around $8.7 billion. So yes, this surplus is definitely positive, and this surplus is because of the major services exports which we had. So these services exports were mainly to the tune of the softwares, which have contributed to the tune of higher exports, which is particularly to the service exports. Travel and also the business activities also were the other components which contributed to this surplus. What our anticipation? Our anticipation is, obviously this time we had seen a 0.6% of GDP, that is the surplus, vis-a-vis 1% which was of a part of GDP last quarter. This time we are anticipating for FY25 the current account deficit to be around 1 to 1.5% the GDP for the FY25. But if we also move on to the manufacturing and services PMI, the manufacturing PMI numbers were also robust to the tune of 58.5 in June as compared to 57.5 in May. And in all sectors, if you talk about employment, output, delivery time, if you talk about purchases, everywhere we have scored well. So that has been a major contributor in terms of manufacturing. Also, if we talk about services PMI number, that has been positive to the tune of 60.4 in June as compared to 60.2 last month. Let's move on to understanding about the inflation and the growth trajectory and the rates trajectory after that. So if we talk about a CPI number, our CPI number came in at around 4.75% in May. In line with expectations, we can say. A couple of things to note is food inflation still remains sticky to the tune of 8.69% versus 8.7% last time. In fact, if we talk about the food inflation and the vegetable inflation in it, so vegetable inflation still remains around 27%, which is again still higher. So food inflation remains a cause of concern, but core inflation came in lower to the tune of 3.1% versus 3.2%. So we are good in terms of the core inflation data because that gets food and energy out of it, but food inflation remains a concern even now. The expectation for FY25 for us, where the CPI we think may remain around 4.5%. The major concern still remains the adverse weather conditions, the heat wave, the seasonality factor coming into picture, and supply side disruptions are also seen to a large extent. So these things are major contributors which can add to further inflationary pressure, and that is why we are eyeing this for FY25 CPI to remain around maybe around 4.5%. But on the other hand, if we talk about growth, the growth number looks to be very robust to the tune of 8.2% versus the estimate of 7.6%. While if we talk about the GVA number, that is for FY24, it came at 7.2%. So there is a differential between GDP and GVA which is of 100 basis point. Now this differential used to be around 20 basis point, but now because of the indirect taxes, this has been higher. So that is one concern between the GDP and the GVA, the spread is higher. Secondly, it's also important to understand the consumption and investment story, because the investment is having more than 7% of growth, but the consumption on the contrary is less than 3%. So there is some kind of disbalance we can see between consumption and investment, which remains a cause of concern irrespective of the overall number being at 8.2%. So if we boil this down into how do we foresee the rate trajectory, for RBI, we expect only one rate cut for the year 2024. That may happen maybe in December. Monsoon remains a crucial role. Weather conditions and inflationary pressure definitely remains the major pointers to be considered when it comes to the rate trajectory. So December is something, one rate cut is what we are eyeing for 2024 by RBI. If we move on to the other dynamics and the fiscal parameters, then it's also important to understand after elections two things which will remain crucial for the investors to watch. One is the government 100-day plan and one is the budget. So if we talk about the 100-day plan, the focus remains on agricultural products and improvement of export value products. Then the focus remains on Ayush Bharat. It remains important that the senior citizens above 70 are considered into it. Then Nasha Mukt Bharat. And apart from it, we are focusing on other activities like imprisonment laws to be changed from July 1st. J&K has an important assembly polls happening in September. Technological advancement, digital empowerment, and also the use of artificial intelligence. So these all are a part of the government 100-day plan. Apart from it, if we talk about budget, so the budget is anticipated to be in the third week of July, so the commencement of the monsoon parliamentary session. Already meetings have been done by the Finance Minister Nirmala Sitharaman with the economist as well as industry standard people, where they understood what are the requirements. On June 19th and 20th, this meeting was already conducted. So we are hopeful that this budget can lay a roadmap for further FDI flows or FPI flows to come into India. So this remains the overall broader perspective, both from the monetary and fiscal perspective, and India stands a strong growth story at this point in time. So this was purely from the domestic perspective. So let's move on to the global parameters and sentiments to understand that what's happening on that side. Let's first talk about the Brent crude prices. So first, it's important to understand the geopolitical factors which are under play, particularly the Middle East crisis and the Red Sea crisis. So taking those into consideration, there are obviously supply side disruptions into picture, which is creating some kind of demand for the Brent crude prices. Also, summer is coming into picture, so summer demand is also adding on to some pressure on the Brent crude prices. If we break down this into the Indian context, then we need to understand that we are importing more oil from Russia at a discounted rate, and now it's at record highs of around 2.1 million barrels per day. In fact, we were importing from Saudi Arabia, which is now at 10-month low. So for India, it's still a good story, but overall, if the Brent crude prices are moving against us, it still definitely affects us on the current account and the trade deficit front. So broadly, if we talk about the numbers for Brent crude prices, we anticipate $77 per barrel to act as a very important support, while $94 per barrel to act as a resistance. If we talk about the Chinese yuan now, because that is again something purely from the export competitive perspective and rupee relations, creates a lot of volatility in the dollar INR pair. So Chinese yuan has been weakening since November 2023. In fact, if we talk about the levels, it has grown to around 7.28. Even the central bank has been fixing the midpoint levels weaker on the onshore yuan front. They are also struggling when it comes to housing. It is also a struggle for them in terms of manufacturing up to the demands or the expectations. So China's story still remains slow. And for Chinese yuan, thus, the central bank still continues to be accommodative in nature. In fact, there have been also talks about quantitative easing, wherein the central bank might buy its own bonds, which is creating some pressure as well on Chinese yuan. So for Chinese yuan, or we can say offshore yuan levels, we are acting 7.18 as an important support, while the near highs of 7.35 to act as a resistance. Let's move on to the most important and the most talked topic is about the Fed policy and their actions. So if we talk about the data points from the US, they have been mixed. Also, if we talk about the statements coming from the Fed speakers, they have been a bit more hawkish, which means the Fed rate cut trajectory moves towards a bit more right. So under the analysis which we are doing, we personally feel the expectations of rate cut or the actual rate cut may move towards or near the election phase for the US presidential elections scheduled in November. So I think September or December could be a month where we see a rate cut by the Fed. But as of now, considering the data points and the Fed speakers, we anticipate only one rate cut by the Fed for the year 2024. And for the year 2025, we expect 3 rate cuts by the Fed. Our anticipation for US 10-year yields is also in the range of 3.9% on the lower end, while 4.6% to act as an immediate resistance. As we discussed about the US elections, which is on November 5th, it's important to have some discussion about it as well. There are two parties. One is obviously the Democrat and the Republic. Democrat headed by Joe Biden, while Republican Party headed by Mr. Donald Trump. So there are two presidential elections debates which happens usually. So one is on 27th of June, organized by the CNN, and the other one is on September 10th, organized by the ABC News. This is kind of a rematch of what happened earlier between Joe Biden and Donald Trump, which is important to watch out. Apart from it, obviously these elections, the number of seats swing states have is something which is more crucial, because there are some states which are predominantly for Republicans, and there are some states which are predominantly for Democrats. But those are the swing states which create a lot of differences. So swing states to be watched out. If we also talk about the Fox News polls, since last 2 months, if we talk about April and May, Biden was not leading. He was behind Donald Trump as per the polls. But for the month of June, we have seen that Joe Biden leading by 2 percentage points higher in terms of the polls as compared to Donald Trump. So there is a lot of action left for the elections to come in, because obviously it's still a long way to go, but it remains an important consideration to watch out. So if we draw this line to dollar index now, what is our view overall considering the Fed policy as well as the US presidential elections? For us, we anticipate 102.80 to act as a very important and strong support, while 108.25 to act as an important resistance for dollar index. So that was from the dollar index perspective. Now let's understand what's happening with euro, because again, if we are talking about elections, then there are 2 more elections which are most important and very recent also. One is the French elections and one is the UK elections. So talking first about the French elections, there has been a snap election called by the President Macron now, and there is a reason behind it. So let's move to what happened a couple of days earlier. So there was a European parliamentary elections where out of 720 seats, France has around 81 seats. And if we break that 81 seats into 2 parties, one is the party which is led by Marine Le Pen, and one is the party of Macron, which is a Renaissance party. So if we break down, Le Pen is holding around 31% of share of seats out of the 81 seats, and the other one, Macron, is holding around 13 to 14% of seats only. So there remains a cause of concern that obviously Le Pen is gaining more prominence. Second, also historically, if we see Le Pen's party, that is the ruling party or the far right, as we say, we have grown drastically. From around 8 seats, they have grown to around 88 seats to be precise, the last elections. Wherein if we talk about Macron's party, they have got 169 seats in the last elections, but still was not into the majority. So obviously coalition was formed and the government was formed. But calling a snap election is a wise decision, or it's kind of a backfiring move. Now there are two cause of concerns which can be raised. One, the MPs are elected by the election, the MPs as in the voting, but the president is elected by the people. And in this case, the French President Macron is elected by the people, and he will be here to the tenure of 2027. So irrespective of whatever results come out of this snap elections, which is on June 30th and the next month, that is July-Sept. So two different dates are there, one polling and the other polling. And if in case, even if Macron's party doesn't win, it really doesn't matter to Macron, because he will still continue to be the president of the France. But it does matter to the party members or the MPs or the Prime Minister who is at the current juncture. So taking those into cues, there has been a risk element and the party is not happy. But if we talk about a global scenario which is happening into the France economy particularly, they are fighting with budget deficit. So the economy is not in shape, and government spending may be cut or raise of taxes may be called. So possibly Macron is thinking that losing is winning, and this could be the right chance where he may not lose the president space also, and also prove Le Pen that it is not easy for her to control, or her party to control the economy considering the scenarios which are now. So this can be an upper hand if they don't perform. And again, to add on to president's term, only as per the election norms, a president can be for a consecutive 2 terms only, and this is the second term for Macron. So if we talk about a third term, that goes to 2032. So it brightens the chances. But a couple of things to understand is Le Pen's party is more against Islam, or they are more against the European sentiment or anti-European sentiment, immigrations, whereas Macron was against some not so good laws, were against retirement and pension. So as of now, Le Pen has been leading in these elections, but one of the concerns was Le Pen has once stated that we need to go out of the EU bloc. So that remains a concern for the euro-dollar pair. So to sum this up, ECB policy is also, we have seen a rate cut from that perspective. So to sum this up, into the euro-dollar pair, we anticipate 1.05 to act as a very important support, while 1.1080 to act as an important resistance. Now let's move on to the other election, that which we were talking about, the UK elections. So that is also an early elections on July 5th. Now again, the House of Commons have around 650 members, 326 are required for a majority. And again, the two parties, Conservative and the Labour, so Conservative by Rishi Sunak and Labour Party by another person who has been very strong enough, which is acting into the nerves since last 10 years, but still have never been finding his own way to enter into the global macro picture for the UK. So now the party has been thinking that there have been problems with respect to the cost of living, immigration, education. There have been several issues which have been talked about. And again, even if we talk about the taxes have been at all-time highs. So again, maybe Rishi Sunak is also of the opinion that he has nothing much to change at this point in time. And if the other person also wins, there can be a lot of political instability wherein Rishi Sunak can be called back again. So again, it's a political game which is run by UK as well. UK inflation has been seen cooling off, and if we talk about the central bank action, the anticipation for a rate cut from UK is probably the month of August. So for the GBP dollar pair particularly, we are anticipating the range to be around 1.2350 on the lower end. On the right side, we are anticipating 1.2920 to act as a very crucial resistance. Now let's move on to the dollar JPY, which is the Japanese yen, wherein we are already seeing levels of dollar JPY testing 160. It has been tested earlier as well. We have made highs above 160 also. We have seen central bank intervention at those point in times, and plus couple of intervention news or verbal intervention have been heard by the Japanese FM, who has been speaking about these things. But there are two things to understand. One is, dollar JPY being at around 160, definitely it's a good sign for exports, because globally their export demand has been tremendous and these rates are very attractive. But it comes with a con as well, because the higher the levels also, it puts more inflationary pressure. On the other hand, if we talk about the central bank, they did trim the bond buying program at this point in time, but July could be one of the months where we can see a rate hike also from them. So overall, if we talk about the Bank of Japan, we anticipate the dollar JPY pair to remain in a broader range of around 150-180, while if we see a break of 160.17, which was obviously the near highs, we can see levels testing around 162.80. So this is more from the broader perspective where we covered the domestic side. We also covered the global macro parameters considering the major currency pairs. But it's time to understand what's there for dollar rupee. because dollar rupee is still the second best currency in Asia. And in fact, if we talk about the range, it has been quite narrow. 83, 83.60 is the broader range where dollar rupee has been playing. So what's there in store for dollar rupee? First, as we discussed in the first half of our domestic factors, where inflows are quite positive. So inflows definitely we see that it will continue to flow on, which may assist rupee, or at least it may not see any kind of sharp depreciation of INR at any point in time. Also, secondly, if we talk about the FX reserves, so the FX reserves have grown from almost around $529 billion to the highs of $655 billion, which is a tremendous jump in terms of the FX reserves. Now, the FX reserves, obviously, one of the major contributors to FX reserves is the foreign currency assets to the tune of $574 billion, followed by gold, SDR, and then our reserve position with the IMF. So, taking those into cues, almost 88% are FCAs, which is the non-US units, we can say euro, maybe yen, or maybe GBP, taking into account. Now, these factors where we have an import cover of around 11 months is very crucial for us, and personally, all the inflows are getting absorbed by RBI as well to a large extent, because we are not seeing any appreciation in rupee irrespective of the flows which we are attracting in, and plus the future flows which we are eyeing. So overall, for dollar rupee pair, we don't expect any kind of sharp depreciation continuing the inflows, but we feel that 83.90 may remain an important resistance zone, followed by 84.20, while on the lower end, the near lows was 82.65. So that may act as a first crucial support zone, followed by 83.35. So that's a broader range when we are anticipating for dollar rupee pair. But what is there in store for importers and exporters? What should they do? Let's start first with exporters. Now, considering the forward premium doesn't favor to the exporters at this point in time, the 1 year forward premium is trading at around 1.61%, which is quite low. But the spot at least is acting in their favor to a large extent, where we have seen levels of even 83.67 levels testing in the market, on the onshore market itself. So our belief remains that anywhere between 83.55 to 83.80, exporters have a good chance to hedge their 40% of their exposure, at least for the near 3 months tenor. While if we are seeing any break above 83.80, we can remain open for that point in time towards the level of 84.20. But that seems to be a bit distant, though we are touching those levels, but it may not be easy to cross the 84 mark at this point in time, because the inflows have been heavy. On the other hand, if we talk about importers, we can break this down into 3 parts. One, if we understand the importers' perspective, forwards in their favor, yes, 1.6%. So 1 month premium itself is around 6-7 paisa. So 3 month premium is less than 20 paisa or around 20 paisa, which is acting in their favor. Secondly, wherever we are getting opportunities, so during election time also we tested sub 83 levels for a day and then we bounce back. So there are a couple of opportunities which an importer do get at regular interims, which they have to cash in. Our view for importers would be that a closing below 83.30 should be the first point of hedging around 30% of their exposure. And considering the inflows which are lined up, if we are able to see levels crossing or closing below 83.10, the second round of 20% of hedging should be done. So almost 50% of hedging with an average of maybe 83.20 odd. If these flows, so for example, the bond flows again have this huge impact and RBI remains sidelined, and if we are able to see sub 83 levels, so between 82.65 to 82.90, then another 20% should be added there. So almost 70% of hedging. And on the right side, what should be the stop, an ideal stop for importers? It should be 83.80. That should act as a very crucial resistance for them. And if those levels are crossed, then at least 50% should be hedged. And then accordingly, for next 50%, a call should be taken depending on the scenarios at that point in time. So broader range, as we discussed for dollar rupee, we continue to expect 82.65 to act as the first important support. 83.90 to act as the first important resistance, and if we provide wings to both sides, then 82.30 and 84.20 remains the broader range for the entire quarter. Well, so that's purely a discussion for importers, exporters, analysis on several currency pairs, global macro trends, domestic factors, and we have formed these views into the several currency pairs. So I hope that this session was insightful and valuable to you. And in case of any queries, suggestions or any feedbacks, you can get in touch on the email ID gtcindia@shinhan.com. It is indeed a pleasure to be here sharing our views. Hope to come back soon in the next quarter as soon as possible. Thank you so much all.